We mentioned that stocks got an early boost this morning after inflation data in the United States, and we'll show you what's happening with the early action in North America right now. The inflation picture showing some signs of easing price pressures, perhaps justifying a central bank skip on a move on rates come September. Let's get some insight and analysis now from Christine Tan, portfolio manager at SLGI Asset Management. Nice to see you.
Good morning.
Did you have any views on the inflation data in the U.S. this morning?
Yeah, it was interesting. I mean, it came in basically almost like a non-event. So it was nothing too hot, nothing too cold. It's in line with this general disinflationary trend that it's now becoming more of the dominant narrative.
Yeah. And are you in the camp that that trend coupled with a somewhat resilient U.S. consumer means that, a recession might not be in the cards for the U.S. economy?
Depends on timing. Our team is still not writing off a recession, but it certainly looks like maybe it's an early 24 or it's kind of more of a mid-24 kind of event as opposed to... Yeah, because what we're noticing this time around is that lag to monetary cycle or policy is really longer and more variable than before.
Yeah.
But it's, when you think about soft landing, it's pretty rare. We've only had 3 in history.
So yeah, that puts it in context.
Yeah, exactly.
We've been on the planet for a long time.
Yeah.
So let's compare the U.S. story to the Canadian story. We'll get some inflation data here in about a week's time, but we already spoke to a guest this morning who thinks it is inevitable, the recession reality for Canada's economy, in part because of the way our mortgage market works. And that makes a lot of sense. I mean, if you haven't refinanced, if you're in the mortgage game, you're going to have to do so, at the very least in the next couple of years, and those with variable rate mortgages have already felt some of that interest rate sting.
And I think that's exactly it.
Yeah.
So the Canada picture is different because of our rate sensitivity. And you heard that a little bit this morning with the Canadian Tire results that you were talking about. Consumers are really more price sensitive. They're spending more on what they have to as opposed to what they want. And definitely trading down where they can. Maybe
if our control room can show what's happening with Canadian Tire shares, they were under some pressure this morning. How would you be thinking about stocks that are tied to the consumer at this point?
You want to really focus on opportunities where the company might benefit from a trade down. So the more value-oriented retailers on the one side, and then you want to think about some of the staples potentially. But with the staples, what I would caution is valuations, because a lot of these stocks have done very well because they are defensive, because they're staples. So you want to make sure that you're checking that valuation box as well when you're looking at these companies.
I think the stat I've seen before, at least, is that over something like 6 recessionary periods in the United States, the only stock that was positive throughout all of them was Walmart.
Oh, okay. I was going to say maybe Costco.
Maybe, yeah, sure. I know. Everyone always needs to load up on massive cans of chickpeas.
That's right.
So I guess, and then for the overall strategy piece for you, are you still leaning into equities right now, or you're sitting on the sidelines?
Yeah, our view hasn't really changed. Okay. We still have a preference for bonds, and within bonds, we prefer high-quality duration over credit. Again, formed by our view that we think the recession is not off the table, but maybe just postponed at this time.
Okay, so fixed income, walk us through what you're thinking there. This is government debt and duration being what?
Duration being sort of neutral to slightly overweight duration, and definitely a preference for government.
Okay.
Because as the economy slows, we do know that the central banks will have room to cut rates.
I noticed, and for our television audience, defensive dividend-paying businesses are on your list as well. How much competition will those companies have with these higher rates and the ability of investors to get paid for something that is directly tied to a government as opposed to, what some company, even if defensive, is doing right now?
And that's a great question, because for the first time in 15 years, maybe, you're actually having to compete against bond yields. So you really have to be careful about where you own defensives, because you don't want to focus on companies where there's no growth and it's purely a yield play. But there are some businesses that do have some growth, although it's much more stable, low single digit, and then they're paying a reasonable dividend as well. Those are some of the defensive names that our team likes.
Okay, so let's take that and then compare it to what everybody's gotten excited about this year, which is big tech and AI this and AI that. And I think the issue is for while you're talking about some very sound ideas, that strategy this year, by comparison to owning, I don't know, what do they call them, the Magnificent Seven?
Yes, that's
would
right.
leave you far trailing overall performance. So how do you think about that group going forward?
I feel like you should talk to Marvel. That could be a new superhero group, you know? And it's a good point, because when you look at the fundamental earnings, they've actually done quite well. I wouldn't say they're stellar, but they've actually been quite good. Google's most recent earnings showed that even the cyclical parts of its business, like advertising, actually beat expectations, grew by 5%. What we're cautious about is just valuation. We think a lot of AI excitement's been pulled forward, and a lot of this resilience that we're expecting from big tech has also been pulled forward into the valuation.
Okay, so I guess to wrap up, this is kind of that sleepy period. We were talking earlier how it has been choppy, but August sometimes can be a little volatile. You've got economic data readings, you've got central bank decisions. Increasingly, we're back talking about geopolitical concerns just based on the battle between Ukraine and Russia, moving to the Black Sea, and what that means for the oil market. Correct. Is there anything else? I get, you got possible government shutdown in the U.S. Is there anything on the horizon that you're going to be watching for that might influence your thinking for the markets, or is this kind of a strategy you're just going to stick with this for the rest of the year? Yeah,
it's a great question. The one thing that we've been watching for, which it actually has happened a couple of times, is credit. We've been watching for a credit event. Under the hood, we don't know what's going on. Exactly. Yeah. But so far, the authorities have been able to step in and put a support under it. So whether you look at Silicon Valley Bank or even the the downgrade of U.S. Treasuries last week. You know, that was basically a one-day, two-day event. But we are still worried about that, because under the hood, especially in the triple Cs and a non-investment grade, you have a fair amount of leverage that at some point, like you said, with the mortgages, has to be refied. Do that, and even Moody's was downgrading some of those regional U.S. banks this week, in part because they've got exposure to areas like commercial real estate. We don't know what's going to happen there. That's right.